Hello and welcome. Today we are going to discuss about when you should be investing in mutual funds through lump sums. SIPs are by far the most common and most popular way of investing in mutual funds that sometimes we give lump sum investing a short shrift. But then there are really many times when you can actually invest through lump sums and you don't need to use SIPs. Here are a few scenarios where you can conveniently and without any kind of large risk invest lump sums. So when your investment amount is not significant, right? Most of us may be investing in equity for the medium term or long term. In which case, the question arises whether you should be using the SIP route at all, right? So this question can be answered if you know what proportion the amount that you're going to invest constitutes in your overall portfolio. Let's take the example of, you're having a portfolio size of say 30 lakhs so far, and you want to invest say something like 6 lakhs. Now, this 6 lakhs as a proportion of your overall portfolio of 36 lakhs comes to about 17%. Is 17% significant enough to make a difference to your portfolio if your investment falls soon after you invest in it? Yes, it does. Anything more than like 10% can have some impact on your portfolio, overall portfolio returns. So the same time, when you say want to invest something like a 1 lakh surplus, that 1 lakh in the overall scheme of your 30 plus 131 lakhs is nothing but little over 3%, right? So is that 3% going to really pull down your portfolio? Unlikely. So that's when you don't have to worry about the risk of mistiming the market. Even if you do mistime the market, the impact on its portfolio, at least in the short term, may not be very painful. And over the long term, and we are talking about equity investing here, you should expect your investment to grow up anyway and compound. And since you're not going to touch it, the compounding automatically happens. So in other words, if this investment is not going to make a significant impact to your portfolio, even in the event of a market fall soon after you invest, it is perfectly fine to invest in lump sum. The next, this is about equity funds where you anyway think long term, right? The next point is about debt funds or low risk hybrid funds. I've just taken, a chart here from an article. You can read the article in the link below for more data. We have taken debt funds and classified them in terms of their volatility and in terms of the percentage of 1 month losses incurred. As you can see, the lower duration funds, the short duration funds have lower volatility and the proportion of loss risk is very low. But the longer duration funds, especially those that have gilts in them, those that try to dynamically play with bond duration like dynamic bonds and so on, have a higher risk of loss. So essentially in debt funds, but even this is, we are talking of a 1 month time frame, right? Over a longer period, actually even this gets evened out. In other words, the risk of mistiming the market is low in debt, provided you stick to the time frame of that particular debt fund. For example, gilt needs an at least 5-year time frame. So if you're investing with a 5-year time frame, there's actually no harm in putting lump sum investments also, right? You will see some fall, but that fall evens out over time. If you're talking of low duration, short duration, there's absolutely no need for you to be, because they are meant to be low volatile funds. So what's the point in trying to average through them? It is a very different matter if you're running a long-term portfolio of which debt is a certain amount and you're doing monthly investments because you're having monthly savings. That's perfectly fine. What we are talking here is SIP is not a bad thing, but lump sum is perfectly fine in these occasions, right? So the first one I spoke about is in equity, where the amount you're going to put is insignificant given the size of your portfolio. The second point that I mentioned here is in debt or low risk hybrid. It doesn't matter. In debt, the longer duration ones can be volatile, so it's okay to do a SIP. But if you're holding them for their longer time frame, like corporate bond or dynamic bond or gilt, then it's okay not to be doing SIPs unless your savings is small and you want to do monthly. There really is no reason. And that's what we have tried to tell here. And in the case of even low risk hybrid, like equity savings, these funds are meant to be low volatile. So what are we trying to average here? Not much, right? So if you do have a lump sum, you don't have to do an STP or SIP. You may well go for, one-time investments. However, if you don't have money, you want to spread it out because you can only save, say, 1,000 rupees a month, then you don't have a choice, right? You go for SIPs. Another thing is switching. This is a very often asked question, whether switching between funds within the same asset class. For example, you're moving from one flexi cap fund to another flexi cap fund, or from a mid cap fund to a small cap fund, and etc. You're basically moving money between the same asset class. The moment you take out the money, many people think this is a large sum. I have 5 lakhs in hand. Should I be starting SIP again in the other fund? Not really, not necessary. The reason is that you are holding in the same asset class, which is equity. The market conditions were what they will be had you held the old fund or the new fund. You're simply moving your money from here to the other fund, essentially from A to B fund. So your cost is actually the original cost of the A fund. So even if you put in the B fund lump sum and the fund falls, you really don't have to worry, because your original cost was what it was earlier, right? When you initially invested in the A fund. And remember, when the market falls in such scenarios, even if you had held on to the A fund, the market would have fallen, right? So there is really no market ill timing, provided you don't leave a long gap, say 2 months, 3 months, 5 months, 6 months between switching. So the moment you come T+2 or T+3, you get this money, and within a week you're putting in the next fund. That's perfectly fine. So you don't, in fact, by spreading it over a long time, you're missing out on compounding. You're allowing the money to compound in A. Now you're slowly again investing and delaying the process of compounding. You can well avoid it. So equity to equity, debt to debt, you really don't need to invest in a systematic manner. The last point is when the market scenario calls for it. When there is a correction in the market, even if you were running SIPs, if you have some lump sum in hand, it is a good thing to be investing in those same funds where you're running the SIPs, additional sums, because that is when you are really averaging. With SIPs, you average on the upside and you average on the downside also. You don't know. You don't have a call over here. You don't have a say over when you will be averaging. But when you're putting lump sum, you have a choice to time if you can. That is, you don't have to do it in one shot. You can set this aside, like say 2 to 5% of your portfolio in cash or in liquid funds, and do these lump sum when the market calls for during corrections in 2 or 3 tranches. So that's about the reasons why you can do a lump sum as well, and when you can do lump sum investing in mutual funds. Please subscribe to our channel, and if you have any comments, please put them here. Thank you.